What's up, stock compounders? Brad here. So Mohnish Pabrai delivered a virtual talk at Boston College in mid-October, okay? It was just released on November 2nd. This was an action-packed Q&A/lecture that Mohnish Pabrai gave. He basically broke down Tencent's business model in a way that a 5-year-old can understand, okay? And such a powerful business model Tencent has. And there's some incredible lessons to learn in how Pabrai actually got to the core of this business model, because it's not something Pony Ma, the CEO of Tencent, talked about, right, in the annual reports or the earnings calls. So there's just a lot here in this talk. So let's jump right in. The first thing Pabrai opens up with is this talk that Peter Thiel gave at Stanford. Okay, it's a class that Peter Thiel taught at Stanford. The class was called Competition is for Losers. Okay, and the idea here is if you're looking to join a business, if you're looking to start a company, make sure that you have some strong competitive advantages, okay? That you're not going into business or even going to work for a business that operates in a very competitive space, all right, where it's really hard to earn a buck effectively. Just the competitive forces are so strong. And this is the case for like 99% of businesses, okay? The vast majority of businesses are exposed to these pressures, right? These competitive pressures. So the point here by Peter Thiel is make sure you find that 1%, all right, where there's some competitive advantage that allows the business to thrive, right, to prosper in ways that most businesses can't because of these competitive pressures. And there was a really big takeaway from that idea. And that was, if you're a business with a monopoly, right? If you're one of these 1% businesses that has incredible competitive advantages, you will go out of your way to convince everyone else, to convince the world that you don't have those competitive advantages, that you're not the monopoly that you actually are. And I noticed this a lot in the big tech hearings, where Jeff Bezos, he talked about, being raised by an immigrant father. He talked about how at the beginning of Amazon, he was packing the boxes to be shipped, right? The boxes of books, he was packing them himself, okay? So it's a real rags to riches story. I mean, you got Google talking about how, obviously they dominate search, right? Online search. But, if you put that in perspective, right, of the entire internet, they don't look very big. So you've got these tech giants that are clearly monopolies that are framing themselves in a way that make them look like small fish in a big pond, okay? And the reason for that, the reason that companies that have a monopoly don't want to tell the world that they have a monopoly, they don't want to draw attention to themselves from regulators, they don't want to draw attention to themselves from competition, right? Because that can easily chip away at their advantages if everyone sees what those are. It's a lot more difficult to defend those. I like what Pabrai said, and I think this was from Warren Buffett. A whale only gets harpooned when it surfaces, okay? So if you don't know that it's a whale, if you have this monopoly that's kind of flying under the radar, nobody's going to harpoon it, okay? Because it's not clear that it's got all of these, say, unfair advantages. So that was a great, a very useful insight from Peter Thiel that, the more I sit with, the more powerful I realize that insight is. But a big problem with that insight is that, if we're combing through annual reports trying to identify, all right, who are these great monopolies? Who are these great businesses that we can put our money with and ride off into the sunset of the compound growth engine over decades. If management isn't going to tell us that it's a monopoly, they're not going to kind of reveal the secrets about what makes them have these great competitive advantages, it's a lot harder to identify, what these businesses are that have these characteristics, especially if they're going out of their way to highlight how they're just a small fish in a big pond, right? They're not a monopoly. They're operating in a very competitive environment. It's tough to make a buck, all these things. And you've got the opposite as well, where you've got the 99% of businesses that are operating in this environment of, fierce competition, pointing out all of the ways that they have advantages, right? So but the monopolies are trying to hide their monopolies. And then you have all of these non-monopolies that are trying to point out why they're actually monopolies. So it's the opposite of what's actually true, what these businesses are saying. So I don't know, I just found that to be a very powerful insight from Peter Thiel and also from Mohnish Pabrai. So what Pabrai gets to next is how Nick Sleep and Koos Bekker of Nomad Investment Partnership, right? They bought Amazon, they bought Costco, they bought Berkshire Hathaway. They had very few companies in the portfolio. And they spent the vast majority of their time reading, right? Koos didn't even have a desk, okay? He just had a chair where he would sit and read in that chair. I think largely annual reports. And so Pabrai points out here, if he only read annual reports for Tencent, there's no way you can get to what makes Tencent special, to what makes Tencent this incredible monopoly business. So it's a big challenge for investors to identify these things. And Pabrai did that. He read through, I think 2003, Tencent went public. So 18 years of annual reports Pabrai went through. And he couldn't really get very far at all in terms of what makes Tencent great. So then he got the idea. There's this little company in South Africa called Naspers. Okay, it's like a 100-year-old newspaper company that started to make investments in the end of the 90s. So it kind of built out its investment portfolio. And Koos Bekker, right, was the first hired gun CEO for Naspers. It had been a family-run business for decades. At some point, I think it was 97, 98, Koos Bekker comes along and he says, look, I don't want a salary. I don't want bonuses, okay? I'm not even going to have you sign a contract, okay? If you want to get rid of me, you can just kick me out the door, okay? No severance package, none of that. All I want is 3% of the upside, 3% of the value that I'm able to create at Naspers is what I want for compensation, okay? So that's, it's pretty rare that you get a CEO come along that wants that kind of arrangement to be CEO. And so we're like, absolutely, right? There's no downside here. If it's a flop, we don't have to pay you a thing. And if it's an incredible win, right? If you're an incredible manager, if you're an incredible CEO to this business, we're happy to share the fruits with you, 3% of everything you create. So in 2001, Naspers, Koos Bekker, right, the management team at Naspers, bought into Tencent. It was like a $34 million stake in Tencent when it was still private. And it was like half of the business back in 2001 is what Naspers was able to buy. Now, Koos Bekker was making a bunch of other bets as well. This was kind of peak .com frenzy, right? And a lot of those went to zero. But Tencent turned out to be one of the greatest investments of the decade, right? It's one of the greatest investments I've ever seen a CEO at a company like Naspers make. But the thing that makes Tencent really great in terms of an investment from Koos Bekker isn't the original purchase. Okay, that was fantastic. Obviously, that worked out very well. There was, I'm sure there was a lot of luck involved with that. But the thing that really impresses me about Koos Bekker is that even as Tencent grew in the portfolio, right, grew as a percentage of Naspers investment portfolio to 90%, to 95%, to 97%. Koos Bekker and the management team at Naspers never sold a share. Okay, they did not sell a share of Tencent until 2018. All right, so with Nomad investment partnerships, it seems like one of the big reasons Nomad shut down was because Case and Nick Sleep were getting a lot of regulatory pressure because of how big Amazon had grown in the portfolio. Okay, it was like 30% or so at one point. And so they're getting all this regulatory pressure that they need to diversify, right, to protect their clients, their investors. And, they didn't want to sell Amazon. They were perfectly comfortable with Amazon being, a 30% stake in the portfolio. And so eventually they just closed up shop. They returned all of the money to their investors, and they just held on, right, the same allocation in their personal accounts. And at one point, Amazon got to like 70% of Nick Sleep's portfolio. At that point, he cut it in half, right? 70%. For him personally, just felt like too much a chunk of his net worth. So he trimmed Amazon. Now, in the case of Naspers, right, this is a public company, right? It's not somebody with a 70% stake in their personal account. All right, it's a public company with a 95+% stake in one company, in Tencent. So, it just shows how committed Koos Bekker was to riding that winner, okay? To be able to block out all of that noise, all of that pressure, to trim that back, it just speaks volumes of the fact that Koos Bekker was really able to focus on the right things and stand firm when he knew that it was the right decision to do that. So let's see. Yeah, those are the first couple points I really wanted to touch on. Pabrai gets a little bit into Amazon and how, with AWS, I don't know when AWS started, but by the time Jeff Bezos, told the world about AWS, I think it was like 2014 or 2015, it was already pretty large, right? It was a pretty established piece of Amazon at that point. It's just a testament to, when a great CEO knows that they're sitting on gold, right? And if they show their hand too early and invite all of this competition, all of this potential regulation, it can really kill the golden goose. Okay, so Jeff Bezos, he knew that, and although he was, very forthcoming in his letters to shareholders about, many aspects of Amazon's business, and did an incredible job teaching his stakeholders about what Amazon was doing. He kept AWS very close to his chest, and it's pretty obvious now why that was so important. Right after he kind of pulled the curtain open on AWS, you've got Microsoft going after cloud, you've got Google going after cloud, but the lead that Amazon was able to build by growing AWS kind of underground, so to speak. It's going to be really hard to catch Amazon. So that's a pretty fascinating case study as well. Let's see. So yeah, to me, the highlight of this talk was Tencent. Just how Pabrai was able to break down Tencent's business model after seeing what Koos Bekker had to say. So after going through 18 years of annual reports for Tencent and not really coming up with much, Pabrai decided to see what Koos Bekker was saying about Tencent. Because who knows Tencent better than Koos Bekker, a guy, an outsider who bought into Tencent before it was even public, okay, in 2001. Naspers had, I think, 2 board seats with Tencent. So obviously Koos Bekker has had very close relations with Tencent and the board and Pony Ma, who's the CEO of Tencent. So Pabrai thought, well, I can't get anything out of Pony Ma looking at these annual reports for the last 18 years. Maybe I can get something out of Koos Bekker. So he looked at all of the transcripts for earnings calls, all of the annual reports for Naspers going back 20 years since they bought Tencent. And Koos Bekker had some things to say about Pony Ma and Tencent, which is fantastic. And one of the projects I want to do, some of you might be able to do this much more efficiently than I could. If you go into Ticker Terminal, okay, Ticker is a free tool that I use all the time. Go to Naspers and click on this transcripts. You can see they have transcripts within Ticker for analyst calls, M&A calls, earnings calls, all the way back through 2010. Okay, so 11 years. It doesn't get us all the way back. But what I would love to do is create a PDF with all of these transcripts just lined up one after another in one massive PDF, kind of like the PDF for the Nomad Investment Partnership letters, so that I can Control F, Pony Ma, Pony, Tencent, and just see all of the things that Koos Bekker over the years said about Tencent and Pony Ma. But Pabrai did that for us. Of course, he didn't share everything he learned, but he shared a few things. So let me just find the notes there, right? So let's break down Tencent's business model. First, Koos Bekker, here's what he had to say about Pony Ma and Tencent. There is no management team on the planet, okay, in any tech or non-tech business, anywhere in the world, right, that is better than Tencent, okay? That's what Koos Bekker had to say multiple times about Pony Ma and Tencent. Now, obviously, a major part of Koos Bekker's net worth today is a result of this investment in Tencent, this early bet on Tencent. So, it's possible, it's likely that he's just drank the Kool-Aid, right? When so much of your success has ridden on this one bet in your career. So is that what's shaping this statement from Koos Bekker, or is there actually something we can sink our teeth into behind Tencent's business model? And Pabrai pointed out also, he said, if you look at kind of, these 7 big tech companies, right, in the US and China, something became clear to Pabrai after really kind of sitting with it for a while, trying to understand why would Koos Bekker say this about Tencent. So Pabrai says only 2 of these 7 tech giants can execute capital allocation well, all right? And this kind of lays out how we can see that. So in an environment like what we're in now, very low interest rate environment, if you're holding cash, you're making less than 1% on that cash, okay? Now, these 2 businesses that are net debt, okay? This is a whole new concept for me because I'm used to looking for net cash on the balance sheet, right? It's a kind of a, what do you want to say? It's like a cushion, right? If something bad happens, you can ride out that storm if you have, a net cash position on the balance sheet. But the way Pabrai is looking at this, if you have a bunch of cash sitting on the balance sheet, you're making less than 1% on that, okay? In the case of Tencent and Amazon, where you have net debt on the balance sheet, they're plowing everything back into the business, okay, to growing the business. In the case of Amazon, throwing more up against the wall, seeing what sticks. That's really Amazon's approach, is trying new things, not allocating much to them, making many bets, and knowing most of them are going to fail. So, any given bet that fails, it's okay. It doesn't do anything to the success of Amazon. But you can see here, Amazon and Tencent would much rather be borrowing at 1% to grow their businesses than having cash earning less than 1%. So that's kind of a different framework than what I'm used to looking at. But let's talk about Tencent's business model. So Pony Ma has a very simple business model, right? A 5-year-old could understand this. There's only 2 businesses within Tencent, all right? The first is an army of software engineers, okay? This army of software engineers, well, first of all, and who is it that's mentioned this before? Naval has talked about this a lot. Being a coder, right? Being a software engineer, if you are an incredible coder, your output is going to be 1,000x what an average coder is, maybe even more than that, okay? So when it comes to, it's hard to think of another job, another activity where the delta between the best and kind of the average, even good, is so much different, right? 1,000x difference. So the first business model, right? Every year, Tencent is hiring thousands of these incredible software engineers to build out Tencent's products, right? Pabrai says they'd be willing to pay $50 million a year to an incredible software engineer, okay? Because the output is just so much more valuable than the average engineer. And Pony Ma, I don't know why I put Tony there. Pony Ma is really good at finding these rock star software engineers. And Pabrai relates it to a massive bazooka, right? Pony Ma has this massive bazooka of software engineers that he could point in whatever direction makes sense for Tencent to pursue. So, that's their first business model, this army, this bazooka of software engineers. Now, this aspect of the business earns 65% annualized return on the capital invested. Okay, 65% year after year. The money that Tencent can plow into this kind of first business model, into these software engineers, is generating 65% returns. Okay, incredible. They wish they could plow all of their free cash flow into this first business model at 65%. But of course, it's tough to scale this quickly, all right? When you're hiring people, when you have to figure out, all right, what projects do we want to focus on? You've got to train these employees. There's a limit to how quickly you can scale that. So, it's not as big as this second business model within Tencent, which is 30 digital Warren Buffetts. Okay, so you've got Tencent acquiring, not as much acquiring, largely taking minority positions in both private and public companies. All right, so you've got this holding company in the digital space for Tencent that makes up the second powerful business model. And that earns 35%, okay, each year. So, that's Tencent's business model. You've got the software engineers, which they would love to be able to maximize how much they could put into that, but there are limitations in terms of how fast that can grow. But that's the mega returner, 65%. And then, you've got the digital Warren Buffetts, which, you can't sneeze at, right? 35% returns. Also an incredible business, just not as incredible as the first one. So that's Tencent's business model. Pabrai talks about why Tencent runs circles around Amazon if you compare the two business models. Pony Ma is never going to hire a driver, never going to hire a warehouse operator and put those people on payroll. He's just hiring software engineers, okay? There's a lot of power to only hiring employees that can produce so much output in terms of writing code, right? There's a lot bigger delta on output and input on a software engineer than there is on employees that operate on a much lower pay grade and don't necessarily have the specialized skills that these software engineers have. So last piece on Tencent, Pabrai says, given the superiority of Tencent's model, it would not surprise me if in 10 or 15 years, it's the most valuable business on the planet. Okay, that's a big statement. I think Tencent's currently around 500 billion market cap. I think I don't have to think about this. Let's look it up real quick. Let's see if I can remember market cap. I don't know if I'm going to remember this. Assets by market cap. We'll see if it comes up. Yeah, there you go. Company's market cap. Sure, good enough. So, yep, this was the one I was looking for. So Microsoft, 2.5 trillion, okay? Down here at Tencent, you've got, between 500 and 600 billion. So that's, maybe a 5x from where we are now. Obviously, Microsoft, Apple, Alphabet, Amazon are going to grow more over the next 5, 10, 15 years. So this is comparing where Tencent is today to where the biggest company is today. We really have to compare to where the biggest company is going to be in 10 or 15 years. So, potentially a 10x is what Pabrai is seeing in Tencent, even though it's already a 500 billion market cap company. So Pabrai, just seems really bullish on Tencent. He said in this talk here that he thinks, Tencent's business model is more powerful than Alibaba's. So to me, he seems more bullish on Tencent than he is Alibaba. We can't see if Pabrai owns Tencent, either if he owns it directly or if he owns it through Naspers or Prosus. He hasn't bought Prosus or Naspers, the over-the-counter tickers, which is ProC and THECY, I think, for Tencent. But it's possible he's bought one of those through the Hong Kong exchange. Okay, we just don't know. And I don't think we'd be able to see if he did, because the reporting requirements just aren't high enough that Pabrai would have to disclose stakes in those companies. So we may never know if Pabrai owns Tencent, but I think there's a very strong chance that he does. So that's, so the takeaway here is if Pabrai had really just focused on reading annual reports from Tencent, a company that he was interested in digging deeper into, he wouldn't have really been able to make any headway into understanding the business, into understanding what makes this business special. he needed a guy like Koos Bekker, right, an outsider investor, to help him see the light. Okay, so this again points to the incredible power of cloning. And I got to give a shout out to Vintage Value Investing. I'm going to pull up their website here. There's something really cool that Vintage Value Invested started doing just recently. I know a lot of you have already heard about this from me, but every quarter, Vintage Value Investing compiles a list of hedge fund letters to shareholders. Okay, and one thing that they just started doing is including the tickers of stocks that kind of get discussed within those letters to investors. Okay, so for me, if I'm considering investing in something like a Tencent, I'm searching. There it is. If you search Tencent in here, or the ticker for Tencent, you can see which great investors are talking about what their investment thesis is for Tencent. All right. So that's incredibly powerful. There's just one in here, but you can click on Nordstern Capital. It'll download the PDF here for their letters to shareholders, and you can just Control F. You can see where they talk about Tencent and really try to drill in to the business model. It's not loading at the moment, and I'm not going to go through that with you guys. I just wanted to point that out. The power of cloning, the power of seeing a business through the eyes of a great investor can really give us insights that we're not going to get just reading through annual reports, just listening to what the management team says, particularly if it is a monopoly, right? If it is a great business, they're not going to show their cards, right? They're not going to reveal what makes them a great business, okay? Especially if revealing that would hinder them in some way. And often it will if you're a monopoly, right? You don't want to draw that attention from regulators. You don't want to draw that attention from competition. When you look at AWS, how quickly Microsoft pounced on that when it was obvious what Amazon was doing behind the scenes for a number of years already. So that's the meat of the talk from Pabrai. I also wanted to just dive into the Q&A at the end. There were some nuggets from the Q&A. So Pabrai talks about, if you're an athlete, right? Say you're Tom Brady, say you're LeBron James, right? Athletes at the top of their game. Now, those guys are going to decline, okay? Age is going to get the best of them, right? Wear and tear on their bodies after all of these years of being athletes. Athletes tend to hit their peak late 20s, early 30s, and then it's just downhill. Tom Brady seemed to stay at the top of his game for longer than that, but it's finite, guys. So, as investors, we have advantages over these athletes, right? Because as investors, if we're continuous learning machines, if we're able to keep an open mind and allow our curiosity to just continue learning, we can compound that knowledge until the day we die, okay? You look at Warren Buffett, you look at Charlie Munger, you could argue they are the best that they've ever been at their craft. So that is a huge advantage in investing, to be able to compound for many, many decades, as opposed to athletes where, that peak of compounding, late 20s, early 30s, and then, your body just can't do it anymore. Okay, so I always get a kick out of when Pabrai makes that comparison between athletes and investors, and it really is true. It's pretty awesome that we've found this endeavor that we can continue compounding our abilities over so many years. It makes it very powerful. Let's see, the Holy Grail. So Pabrai, seems like in a lot of his recent talks, he kind of talks about the Holy Grail as investors. For Pabrai here, the Holy Grail is to find great businesses, right? These businesses with monopoly-like characteristics that have a great future. Okay, they've got a long runway. They're going to continue being great off into the sunset, and to not pay too much for them. All right. This just froze. I've been keeping an eye on that. Let me just refresh that. To not pay too much. So that's a tricky one. It can be a tricky one to suss out. I like how Terry Smith approaches this. Terry Smith of Fundsmith. He looks at free cash flow yield. Okay, so free cash flow compared to the market cap of the business. What percentage is that? I think that's a smart metric to pay attention to when you're trying to figure out, am I paying too much? And what's too much, what's too little? It's going to vary by what industry you're looking at. But I think it's a helpful metric, much more helpful than something like price to earnings ratio. So not pay too much and not get them too late in the journey, right? Perhaps not get Berkshire Hathaway when it's as big as it is today, right? I removed that market cap list, but hopefully find something like Berkshire back when it's like $1 billion market cap or less. And then you can just ride it, right? You can ride it off into the sunset. If a company is already quite large, there are limitations, like gravity, right? In terms of how large it can get. Buffett likes to say a fat wallet is the enemy of high returns. Okay, there's a lot of forces that work against you when you're trying to grow a large pool of capital. And just ride them out. So that's the Holy Grail. He was asked, what resources do you use to find new investment opportunities? And this is nothing new. Pabrai's talked about these before, but you've got Value Investors Club. Lots of horsepower amongst the members. It takes quite a bit to have a write-up, accepted into Value Investors Club. So there's a lot of very smart investors who are submitting ideas there. And, if you haven't had an idea accepted, you have like a 45-day lag time before you can see those write-ups, which, isn't a problem for long-term investors like me. At least that's my take on it. The second one was SumZero. This is like a $10,000 to $15,000 annual subscription where it's similar to Value Investors Club, where investors pitch ideas and you get to read through those ideas and kind of chat with each other as well. So that is not free, obviously, like Value Investors Club is. But clearly Pabrai finds a lot of value in SumZero as well. And then the third one is Value Line. And I've mentioned before, kind of my Value Line hack, getting a library subscription at Fairfax County Library in Virginia. And through that library subscription, you can access Value Line. And Fairfax isn't the only library that allows you to access Value Line if you're a member. I'm sure there's a lot of libraries that you can access Value Line through. So check with your local library before you drop it's like $30 to be a member at Fairfax County Library. And the beauty of this is you don't have to live in Fairfax County, okay? You can be a non-resident member and still get access to Value Line. So that's a pretty cool kind of hack that I discovered not too long ago. And Pabrai says, if someone were to just focus on Value Line, right, and just make 1 to 2 investments per year when everything lined up, right? So you're the batter in the batter's box, waiting for that perfect pitch, waiting for maybe 1 or 2 perfect pitches each year, and that's when you swing. You could do very well doing investing that way. Probably much better than if you're swinging at something every month. It's really Pabrai's mantra of, few bets, big bets, infrequent bets. So I noted here, he said, I don't think the business model for Alibaba is as good as, say, a Tencent. All right. So It's hard to see Alibaba and Tencent growing 10x from here. So if Pabrai were just getting started, right, this was his advice to one of the students here, he wouldn't be looking at companies that are already tens of billions or hundreds of billions in size, in market cap. He would be looking for maybe sub 1 billion market cap companies where you can identify that this company has these kind of monopoly characteristics, these monopolistic competitive advantages before the masses can. Okay, that's really the Holy Grail, is to look to find these smaller opportunities that, before the market recognizes them as great businesses. So yeah, easier said than done, but if you're singularly focused on that kind of a task to identify those kinds of companies and you're not looking at anything else, it's probably going to happen. If you have that Buffett zeal of going to the Exarban racetrack and picking up the discarded stubs, looking for those winning tickets, or reading through the Moody's manuals, right, multiple times, trying to find companies that other investors have overlooked, it's going to happen, right? But there's not that many people that have that fanatical focus on making something like that happen for themselves. Yeah, so let's just check if I have any last minute things. Nope, that's it, guys. That is everything. Thank you, as always, for watching these kind of highlight videos from Mohnish Pabrai's talks. This was one of my favorites. It was phenomenal. So if you haven't watched it already, I think I've watched it 3 times. It's just so good. And then it kind of bummed me out, but the next day, Pabrai put out the talk he did with Oxford, which covered a lot of the same stuff. But I do have notes from that as well. I'll be putting out a highlights video from that talk at Oxford probably in the next couple of days. So keep an eye out for that as well. But with that, guys, I will leave it there. See you all in the next video. Take care.